All right, in this session, we'll be covering learning objective number 2, which covers a few areas which are considered the building blocks of accounting, namely ethics, the subject of ethics, accounting principles, and assumptions. So let's talk about ethics in the accounting world, specifically ethics in financial reporting. Basically, when we're referring to the concept of ethics, we're asking ourselves, uh, what are the standards of conduct by which one's actions are judged? And basically, we're dealing with understanding what is right or wrong, what is honest or dishonest, fair or not fair. Ethics in accounting and financial reporting involve all of these options. So the accountant's responsibility is to record economic transactions and communicate them to interested users accurately and fairly. And oftentimes that deals with uh, ethical issues that may come up, which the accountant has to uh, decide how to address a specific transaction. I'll give you an example. This is a picture of a Honolulu businessman who was allegedly stole or embezzled $4 million from his own company and was convicted of tax fraud in 2017. Basically, what he did was he utilized $4 million of the company funds for personal use, such as to buy a house, to pay for his kids' tuition, etc. And he had the accountant record these expenditures for personal use as business expenses of the company. And the IRS, after auditing their accounts, determined that they were really not business expenses, but they were really withdrawals of funds from the company by the owner for personal use. But the accountant recorded them as business expenses so that they could deduct it from their revenues to determine how much taxes the company should pay. Well, the IRS says you can't deduct personal expenses against your business revenues for tax purposes. So basically, he was caught, and he's now in prison. This is the dilemma that sometimes accountants face when they are confronted with an ethical issue. They have to make a decision whether or not what they're doing is honest, fair, and accurate. And if they're not ethical, then this is what will happen. So the concept of ethics in financial reporting has been a long-standing problem in the business world. There have been many financial scandals in the past, including Enron, WorldCom, HealthSouth, AIG, Lehman Brothers, and other companies due to dubious accounting and financial reporting practices. This resulted in big losses for investors in the stocks of these companies. As a result of these big financial scandals, and the scandal basically deals with the accountants and the management cooking the books of the company. In other words, inflating the revenues or not reporting all of their expenses, which results in inflated profits. So they're under great pressure to the stockholders to continue to report growth in sales or revenues, along with growth in profits. So if they're not growing the way they want them to, then sometimes they can cook the books, so to speak, where they inflate the numbers artificially and make it look much better than what it really is, causing investors to continue pumping money into the stocks. And in the end, what happens is their dubious accounting practices are discovered and everything comes crashing down. So the regulators and lawmakers in Washington, D.C. were concerned that if this continued on, the economy would suffer if investors lost confidence in the corporate accounting requirements. In response, Congress passed what we know now as the Sarbanes-Oxley Act to make it difficult for the managers of the company, the CEO and the CFOs, to manipulate the accounting transactions and reporting. Otherwise, they could face big legal fines and jail time. And the reason for this is because we have to have sound ethical behavior on the part of the accountant if you're going to believe that the numbers that are reported are fair and accurate in terms of how the company is doing. So what the Sarbanes-Oxley Act requires is that the managers and auditors of public companies, they have to document and certify that they have a system of internal controls. We will talk about the topic of internal controls in a later chapter, but basically internal controls covers the policies that govern how transactions are handled and recorded by the company. So these are the two individuals, Paul Sarbanes and Mike Oxley, who wrote up this bill, which was passed by Congress, that requires managers, the CEO and the CFO of publicly traded companies, corporations, to document and assess the effectiveness of all internal control processes that can impact the company's financial reporting, and that these controls and processes must be attested to by independent auditors. In other words, they have to pay outside accountants to come in and review their controls so that they can get a third-party assurance that the controls are effective. The penalty for not doing this is quite serious, in that the CEO and the CFO could face civil and criminal penalty charges for non-compliance. Okay, the next topic is the concept of generally accepted accounting principles. Basically, this is the rules and the conventions that all accountants must follow when recording and reporting economic transactions to interested users. So we discussed who are the users. There's both internal and external users who need financial information to make business decisions. The financial information basically comes in the form of financial statements. And there are a few statements that you will learn, including the balance sheet, the income statement, the statement of stockholders' equity, and the statement of cash flows. So what happens is that the accounting profession has a set of rules or standards that are generally accepted and universally practiced by all accountants in the United States. that determine how economic transactions are recorded and how they are reported. These are in accordance with generally accepted accounting principles, or GAAP, G-A-A-P. So the financial statements that every company puts out has to be prepared in accordance with generally accepted accounting principles. And we will be covering several principles in a second. So generally accepted accounting principles, GAAP, are the standards that are generally accepted and universally practiced. These standards indicate how to report economic events, and these standards are developed by professional standard setting bodies. The bodies that set the standards include the FASB, the Financial Accounting Standards Board. This is a private group of individuals, generally made up of academic professors and professional accountants that work full-time on this board. And I believe it's based out of Stamford, Connecticut. There might be 20 or so of individuals who sit on that board, and their responsibility is to review and improve, modify existing rules, and create new rules or principles for new requirements that all companies in the United States are required to follow. On top of that, if a company is a publicly traded corporation in the United States, there's additional rules that are governed by the Securities and Exchange Commission in Washington, D.C. They establish additional reporting requirements for companies that issue stock to the public. Generally, they require publicly traded corporations like Apple or Walmart or McDonald's to submit quarterly updates of their financial reports, as well as an annual report that has to be certified by the independent accountant. And then lastly, we have the International Accounting Standards Board, the IASB, who governs the accounting rules for all other companies around the world. So the FASB on the top pertains to the rules or the principles that U.S. registered companies have to follow, and the IASB issues the principles or rules that all other companies around the world have to follow. Now, the rules or the principles between the FASB and the IASB are very close. In other words, they're almost the same with a few exceptions. Okay, let's talk about principles. So there are many, many principles that make up generally accepted accounting principles. I'm just going to briefly discuss a few principles so you can get an idea of what we mean. The first principle is what we refer to as the historical cost principle, or cost principle for short. And basically, this simply requires that the accountant record the economic transactions involving the acquisition of assets, such as buildings, computers, equipment, at their original cost on the accounting records. That means that if a company paid $100,000 for a piece of equipment, it gets recorded in the accounting records at $100,000. Or if they paid $1 million for a building, that's recorded on the records at $1 million. It doesn't matter if the building is worth more, it's still left at $1 million. For example, if a company bought a piece of land for $100,000 5 years ago, and that land today on the market is worth $500,000, when the company purchased the land, they recorded it as $100,000. Today, it's worth $500,000 on the market 5 years down the road. That does not mean the accountant is allowed to change the value of the land in the accounting records from 100,000 to 500,000. They are required to leave it at the original cost of $100,000. The other principle is called the fair value principle, and this is contradicts the historical cost principle in that it means that assets and liabilities should be reported at their fair value, or the price received to sell an asset, or the price to settle a liability at any given time. Now, this principle applies only to a few exceptions when it comes to economic transactions. The concept is that what accountants are trying to do is to report the value of a company's assets or liabilities so that the information that's provided to users is relevant for decision making and that it's a faithful representation of the value. Now, in most situations, the historical cost principle governs. There are only a few exceptions where it may fall back to the fair value principle. And I'm going to list two of these exceptions for you. One is the companies that sell merchandise inventory are required, like Macy's, Costco's, Walmart, even Apple, Microsoft, they sell computers. They're required to report the value of their inventory, and inventory means the assets that they're going to sell to their customers. They have to report it at the lower of cost or market. So what that means is that if the market value of an inventory item is actually less than what they originally paid for the item, then they're required to report the lower of the two. And if you have a item that is worth less than what was paid for originally, then basically what you're reporting upfront is a loss on the item before you even sold it. This will be covered in Chapter 5. The other exception is when a company makes investments in stocks or bonds of other companies, they're required to report it at fair market value also. And we will cover that in Chapter 12. You do not have to worry about understanding how this mechanically actually works until we get to Chapter 12 or Chapter 5. Okay, assumptions deal with basic guidance on how you should look at the business. The monetary unit assumption is an assumption that means that the only transactions that the accountant should record are transactions that impact dollars and cents. In other words, they could be expressed in terms of money. That's why we call it economic transactions. It impacts the company financially. That is what we mean by the monetary unit assumption. The economic entity assumption means that the activities of the entity, the business, should be kept separate and distinct from the activities of its owner and all other economic entities. So if you have an owner of a company who owns maybe 3 or 4 companies, what we mean by the economic entity assumption is that each company should have its own accounting records to keep track of its transactions separately, and that we don't commingle the economic transactions of companies together. We have to have separation between the companies, and as well as a a separation of the owner's personal financial activities from the business activities. That is what the economic entity assumption means. In the business world, there are basically three forms of business structure. We have the proprietorship, the partnership, and the corporation structure. So the basic difference is that a proprietorship form of business is a company that is owned by one person. Only one person owns the company. Then we call that a proprietorship. And that person is often the manager or operator of the company and receives any profits or suffers any losses the company generates, and is personally liable for all the debt of the company. A partnership is similar to a proprietorship in that it is a company that is owned by two or more persons. Generally, the same applies: unlimited personal liability. Often, partnerships are associated with retail service type businesses, such as a medical clinic or a law firm or an accounting firm. And generally, a partnership will require a partnership agreement to spell out who is responsible for what and how each partner gets compensated. And then the corporation is unique in that ownership of the company is divided into shares of stock. So many people, investors we call them, can have ownership participation in a company that's structured as a corporation. This is totally different from proprietorship and partnership in that a corporation is actually a separate legal entity organized under state corporate law. So a corporation actually pays taxes on its profits, whereas a proprietorship or partnership business does not pay taxes directly, but instead the profits or losses flow through to the owner's personal income tax, and they pay the taxes through their personal taxes. Whereas a corporation actually pays taxes separately under its own organization. Difference between owners of a corporation and owners of a partnership and a sole proprietorship is that the owners of a corporation have limited liability, whereas the owners of a proprietorship and partnership are personally liable for all the debts of the company. Limited liability means that the owners, we call them stock investors or stock owners, the only risk of loss is how much they paid for the stock if the company were to go under. Okay, now you can see that I have on the last bullet of each, I have the term owner's equity for proprietorship, owner's equity for partnership, and then stockholders' equity for corporation. They basically mean the same thing when we talk about equity. It's just that when we have a corporation, we have owners who are classified as stockholders. We call the owners of a corporation stockholders, so their equity, we call it stockholders' equity. Whereas a partnership and a proprietorship, the owner is the owner, so we call it owner's equity. Okay, so that completes the second learning objective, and in the last session we will cover the 3, 4, and 5 learning objectives. So that will be the end for this session.